Hello and welcome, everyone. My name is Ismael Ray Reyes, Managing Principal and Founder of the Admirable Group, one of the general partners of the Stoney Creek Highlands Apartment Homes investment opportunity in Rapid City, South Dakota. Let's go ahead and get this presentation started and kick it off into presentation mode. Stoney Creek is a 278 unit Class A trophy asset. For those of you that don't know about Rapid City in South Dakota, be prepared to be impressed and shocked. It's one of these hidden gem markets that a lot of people don't know about. This market is experiencing growth better than some of the top performing markets in the country. And you just don't hear about this place. Again, we're super excited to be a part of this deal and to be able to offer it to you. Since nothing tells a story better than images and video, let's start off with a short video of the property. Just a gorgeous property. In this presentation, my partners and I will introduce a very experienced sponsor team, provide an overview of the project and market, dig into the business plan, and provide the next steps for those of you that want to invest. A quick disclaimer before moving forward. All investments have risk. Please review all materials carefully before investing. As I mentioned earlier, I am the managing principal and founder of the Admirable Group. I am also the president and founder of MI Real Estate, acquiring over 1,000 doors valued at over 130 million. I retired as a lieutenant colonel of the United States Army after 28 years of service to do this, and I truly love it. Over half of my acquisitions have been with my distinguished partners on this slide, who you will have a chance to hear from in this presentation. Winston Schofield is a managing partner and our director of operations. Alfredo Hooker is our director of finance and acquisitions. Tim Little is our director of research and analytics. Kelly Iano is our director of marketing and investor relations. And Marshall Masterson is our director of asset management. My team has a strong overall track record with a collective real estate experience of over 50 years. 11 acquisitions valued at over 135 million, with 6 that have gone full cycle. We currently have just under 500 units under management and valued at over $58 million. Before I turn it over to my team, I'd like to discuss the lead sponsor. Elevate Commercial Investment Group, co-founded by Georgia Brew and Eric Badawala, are located in Dallas, Texas, and started in the multifamily space over 5 years ago. Over the last 5 years, they've acquired about 6,000 units in 7 different states, sold about 1,600 units. They currently have about 450 million of properties under management. I've known George and Eric for over 3 years, and we actually had the opportunity to partner with them on a project in Augusta, Georgia, which doubled investor money in just over a year. It was definitely one of our best investment partnerships. George also leads JNT Construction, the general contractor which handles the renovations at their properties, and they have recently vertically integrated property management into their operations, yielding significant cost savings and improving the consistency and control of operations. This will be their second asset in Rapid City and third in South Dakota. And as you can see, both properties are doing extremely well. I will now turn it over to Kelly to continue with the investment overview.
Thanks, Ray. Excited for further details. First, let's look high levels at the market. This asset is located in South Dakota, and while it caught some of our investors totally off guard, as it did with us as we started looking at it, you'll be quite surprised at the metrics of this market. We can't overlook the favorable trends that Rapid City, South Dakota specifically, which has been one of the fastest growing markets in the Midwest, really has been demonstrating. So, since the 2020 census, the population of this MSA of Rapid City has grown more than 7 times the national average, which is something that gets us really excited as we think about future opportunity to continue to grow rent, grow the business plan, as well as when we think about housing supply. This is a market that is short on the housing supply. And so what you'll see as we continue to go through is that we've historically had high occupancy levels at this particular property. And we've got plans in place to continue that trend as we go forward. The other thing that really gets me excited about Rapid City specifically is that not only is the state, but at the city level, they're really committed on continuing the growth of this city and this market. In fact, the chambers of commerce for the city, as well as the business development for the city, some of these officials came from nearby Colorado, which we all know has had explosive growth in the last 10 years or so. And so we're really excited about them coming to this market. They're super excited about putting their really impact on it and growing it like they saw in the Colorado area. The property itself, Stony Creek, is a stunning property that was built in 2008. So it's a newer class asset. It's an A-class asset. It's been meticulously maintained by the prior owner. And this prior owner, or the current owner, excuse me, is the original developer. They intended to hold this property long term as a legacy within their family. However, due to a change in the family, they're now selling this asset. But because they plan to have it as a long term hold, they were meticulous on the maintenance schedule of it, on having the proper staff team who could handle the maintenance, as well as meticulous on the reporting for this particular property. So we're super excited about being able to transition this property into our portfolio. It's been sourced off market through broker relationships that the lead sponsor Elevate has, which allows us to acquire the asset without going to market and competing against all the other operators who, quite frankly, would love to have this asset. Super strong. We've got a business plan in place that really calls for us to add value through organic rent increases as leases expire over the next 12-month period. We're also looking at adding additional additional revenue streams. We've got a couple ideas there, which we'll talk about. And then also just making some updates to the amenity package. This is a light renovation plan or light CapEx plan. But we think some strategic upgrades will allow us to continue to push the rents not only to market, but then also get a premium on them for a select number of units. Oh, and did I mention that we're near our year one performance numbers from an income perspective now? When we negotiated the purchase of this particular asset with the seller, we were able to negotiate that as they have leases renew and expire, that they push them to what market rents are. So we are already seeing rents that we have in our underwriting for performa actualizing in leases. So we're super excited about that. Again, we'll talk about financials a bit more as we move forward. We'll go through the high level financials, but again, my team members will take you through in greater detail as we move through this presentation. We're purchasing this asset at about $46.7 million, and we anticipate holding it between 5 and 7 years. All the returns we walk through are based on a 7-year hold period with a supplemental loan in year 4. We've got our returns here, average cash on cash between 6 and 7%, internal rate of return over the whole period between 15 and 18%, and then equity multiple, it's super robust in that mid to equity multiple. So looking at doubling your equity over the whole period plus some. We're pleased to offer 2 different share classes, starting with an 8% preferred return. And with this 8% preferred return, we have an equity split of or return split of 70/30 in favor of the limited partners. And then once we hit a hurdle of 16% IRR, then the split would go from 50/50 between limited partners and general partners. So We're really feeling confident. We've got some great returns in here. And as you'll hear, we are hitting some of these income metrics. So we're super excited about what that looks like. And then finally, just to retouch on a couple items of why we love this deal and why some of the investors I've been speaking to love this deal is we're acquiring this off market. This wasn't taken to market where we have a lot of competition and where the price is getting bid up. So we're really pleased with how we are purchasing this property and the price we're getting per unit. This is in the path of progress. I spoke briefly to the really the favorable growth trends of Rapid City, and then again, the local officials really putting a focus on continuing to sustain and grow the business environment and the resident base further there. We have the immediate growth potential. We're already implementing our year one projected rents with the current owner. So we're going to continue to do that as we have the leases turn over on when they expire. And then I didn't mention yet the low risk from a debt perspective. Tim will mention that in a couple of slides, but essentially we're acquiring with long-term fixed rate debt, which does remove that risk of floating interest rates that we've seen in this unprecedented, interest rate growth environment that we've been in. So with that, I'm going to hand it over to Tim to take you through this project further.
All right. Thanks, Kelly. So, Kelly gave you just a few reasons why we're excited about this deal, but let's zoom in and look at the performance of the property up to this point. I know some may be concerned that this is one of those turnaround projects where we take a poorly managed property with low occupancy and make it shine. Let me put your mind at ease and assure you that this is not that. This property has had a physical occupancy of more than 99% for the past 2 years. That is virtually unprecedented, but it is both a testament to how well they've run the property and the demand that exists in this market of Rapid City, South Dakota. Of course, with occupancy near 100%, it means there's a lot of opportunity to raise rents as well. And occupancy is one thing, but are the tenants actually paying? You'll also see by this chart that the bad debt is virtually non-existent here, which means tenants are paying and they clearly have been doing something right from a tenant screening and qualifying perspective on the part of the current owners. Next, it's important to note that this is not a heavy value add. We will not be doing extensive renovations on this property, which helps reduce our costs and the operational risk for everyone who's involved. We will be doing some renovations and property improvements, and I'll cover those a little bit more in the business plan. All right, so the debt. Kelly mentioned it, but everyone knows that the interest rate environment is a bit unpredictable right now. That's exactly why it was important that we locked in fixed interest rate debt to get this deal done. I hope the Fed is done raising interest rates, but there are certainly no guarantees. So we're hedging that risk with a 7-year fixed rate term, with all 7 years being interest only. And I know Alfredo and Marshall will talk about that more in the financials and really dive into the details of the financing, the debt that we're bringing on here. So I won't belabor that too much now. All right. So what is our business plan? As I alluded to earlier, we're going to bring those rents up to market rates. The demand is already there, and you're going to see later that we're already getting some of those rents now, which is amazing to see. And it just gives us further confidence in the numbers that we're projecting. But we'll also be distinguishing ourselves as a property with some of the upgrades that we have planned. We'll upgrade remaining units to get those premium rents that we're already seeing in premium units by adding things like stainless steel and stuff like that that tenants expect in a little higher end unit. Of course, we'll be adding some aesthetic and safety touches like new signage to give it better curb appeal and improved lighting for the walking paths, which we hear a lot of the residents already use because of the beautiful scenery that they have there. We'll be putting some fun stuff in place as well that'll set us apart, like a pickleball court and improvements to the dog park. There are also opportunities for additional income through cable and internet service contracts, as well as the installation of carports. Now, that last one, we're already seeing other comps in the area have carports and have waiting lists to actually rent those out. So we're convinced that's going to be a great addition and bring in some awesome additional income over and above the rent rates that we expect to see. And finally, here's just a few of the amenities that already exist on the property. And a lot of these things are what you would expect in a Class A property, right? You got your Amazon package delivery system, really nice gazebo area, a pool, of course. But you also have this really sweet grilling area, fitness centers. And as I talked about with the dog park, they do currently have a dog park, but we're going to put some money in there to spruce it up, make it look a lot nicer. And then obviously you have playgrounds for the kids that are going to be there. What I really want to get across with this slide is that the tenants already have a lot of amenities. So that's why we don't have to do as much to pile onto that. It's really just about tweaking some things like we talked about, introducing that pickleball court, getting nicer furniture in the outdoor areas, things like that, that'll take an already outstanding tenant experience and elevate it just a little bit more. It's a beautiful property with beautiful views and great amenities. We're just going to capitalize on that fact and continue to raise rents on what is already a property that's in demand and has amazing occupancy and payoff rates right now. All right, now I'm going to cover a little bit about the South Dakota and Rapid City markets. So I'll be honest, we didn't know a whole lot about South Dakota until recently. It certainly doesn't get the same amount of press as hot markets like Dallas and Phoenix do. But once we started digging into it, we were really impressed with the fundamentals of the region. So what is Rapid City known for? It's about 30 minutes from Mount Rushmore, and most people know what that is. You can see that it's also about 6 hours north of Denver, and South Dakota has benefited from migration from Colorado as the cost of living there has increased significantly over the past few years. While it is a little under the radar, South Dakota has been at the top of many lists, especially as it relates to being business and tax friendly and having just a great quality of life. So while I would like to say that Stoney Creek is an outlier with its extremely low vacancy rate, it's actually not. Rapid City has an estimated rental vacancy of only 1 to 2%. So that just tells you it's a really tight market. The unemployment rate is extremely low as well at less than 2%. This combined with its job growth and population growth make for some really strong fundamentals in this region. And I just want to reiterate again that our partners in this deal, Elevate, own a property less than 10 miles away. So we have that economies of scale right there. And not only that, their chief operating officer of their in-house property management company that will be overseeing this property only lives about 6 minutes away from Stoney Creek. So it's really nice to know that someone senior from the property management team can literally drop in anytime they want. Here you get a snapshot of the rapid growth they've seen over the past year. Between the population growth and shortage of housing that's forecasted to continue until at least 2030, it strongly supports our rent projections and appreciation of the property over the hold period. Of course, none of this is possible without jobs. And here you see just a few of the large employers in the region. Of note, Ellsworth Air Force Base will be the home of the B-21 stealth bomber, which besides being really cool, it means that more military families will be moving to the area and creating just more local investment. And just for context, Ellsworth is only about 19 minutes away from the property itself. All right, so hopefully that gives you an idea of some of the exciting trends in Rapid City that makes us so confident in this market. And with that, we'll move on to the financials where Alfredo will kick it off, followed by Marshall.
Thank you. Here shows where the in-place rents are at the property and based on comparable market rents that comes from CoStar, which is one of the largest third-party sources for commercial real estate. We're pretty confident we can bump rents up to $200. The orange line shows the gap based on the comparable properties in the area. The table to the right shows the rent roll summary. It shows rent when the property went into contract and what the highest we can achieve. It was negotiated with the seller that while we were under contract, the seller needed to start raising the rents to markets. This is the strategy that the team has implemented in the past. So before we even close, the property has units that are already at the market rates. The value of the property has been increasing as well prior to the closing. You can see at the bottom table where the in-place rents are at each unit type, where the average market rents we want them to go to. As you can see, there is already several floor plans that we are achieving at or above our pro forma numbers already. We are very confident in the business plan and the strategy. It shows that the proof of concept is in process and being implemented prior to taking ownership of the property. This is an important graph. We want to look at, for a new investment, it shows that the average tenant base in this market can afford these rents. So any real estate operator, property management company wants to at least do 3 times what tenants are making. And as an example, the current average lease rent is around $11.98. And based on what tenant salaries are in the area, it is 6.5 times from what the average rent is. So clearly, we can see the projections for rents for year 5 at the bottom number. The income ratio is almost 5 times. So based on the median household income of $90,000, the tenants can clearly afford these rents. This slide shows the comparable properties in the area by the unit mix. At the bottom, we have the Stoney Creek in-place rents and the projected pro forma rents. It clearly shows that our pro forma rents don't go above the comparable properties. So we still have a clear runway to increase the rents. With that, I will pass the presentation to Marshall, where he will go over the assumption data, pro forma numbers, and expected returns.
Thank you, Alfredo. Yeah, so looking at the acquisition numbers, so the purchase price here is $46.7 million, and that's going to be roughly a 5.3 cap rate using the trailing 12 numbers. And then we're projecting an NOI of 2.9 million, and I'll get into that in just a moment. And you can see the disposition, we're projecting a 5.75% exit cap rate, and we'll show some sensitivities on the next slides. And then lastly, on this slide, you can see the sponsor fees. So the acquisition and loan guarantor fees are at 3% of the purchase price. The asset management fee is at 2% of the effective gross income. And then there's a 1% disposition fee at the sale. On the sources and uses slide, you can see that the deal is being capitalized with a senior loan for roughly 30 million. There's a preferred equity tranche, which will show some additional assumptions behind that for 9.5 million. And then we're raising common equity of 10.2 million. And so that's being used to fund the purchase, roughly a little over $1 million in CapEx for renovations, and then a broker fee of roughly 470,000, the acquisition fee, and the closing costs. So here you can see the senior loan. So this was just recently locked in. So it's at an amount of 30.35 million, which is roughly 65% leverage. And it's going to be a full term IO for 84 months or 7 years. And the rate was just locked in at 5.85%, which is a really competitive rate in this environment. The loan origination fee is only 50 basis points, which is also very competitive as well. In terms of the preferred equity, this was originally 9 million, and the preferred equity provider believes so strongly in the deal that they increased this amount to 9.5 million due to the strong performance of the property recently. And that's going to start at a current pay of 8% for the first 2 years before going up to 10% for years 3 through 5, and then up to 15% for years 6 and 7. And the total pay on this preferred equity is 15%. And then the pro forma assumes a supplemental loan at the end of year 4, and that will be approximately 12 to 13 million. Yeah, here it is, 12.9 million. And so that's part of the underwriting as well. So on the pro forma, you can see that we've got the trailing 1 month income over the trailing 12-month expenses, next to the trailing one income over the pro forma expenses. And then we jump into pro forma years 1 through 7. But the main takeaway on this slide is that you can see that the net rental income for just the trailing 1 month financials at 4.2 million, call it, is right on top of where the pro forma year 1 numbers are. This deal is tracking very closely with the underwriting, which is really a great indication going into it. And then you can see what that is in terms of a cap rate coming in. In terms of the pro forma numbers, we budgeted roughly, call it 1.7 million in OPEX or operating expenses. And that's resulting in a projected cap rate of about 6.1%. And we've budgeted a pro forma year 1 cap rate of 6.21%. So we're almost there, and the deal hasn't even closed, which is really a great sign. And then looking at some of the stress tests for the deal, this is a Class A minus deal, recently built, and it's a pretty large institutional quality deal. And we've underwritten the deal with an exit cap of 5.75%. And my initial inclination was that this is very conservative as an exit cap rate. And so to show you what that means in terms of a gross exit price per unit, that's roughly 263,000 per unit at a sale in 7 years, which feels very comfortable. And that would result in an IRR of 16.3% for LPs and the resulting multiple of 2.7x, which is pretty strong for such a long hold period as well. And you can see as the exit cap goes up, we show the projection up to 6.25% here. The LP IRR is still very close to 14%. And it just really speaks to how robust this deal is. And then you can see below, in terms of the break-even occupancy in year 1, we've got fixed rate interest only debt for 7 years. So this is showing 77% as a break-even occupancy. And the market is very strong. This deal is almost 100% full. And so we feel really good about the ability for this deal to perform given some of these stress tests and metrics. And then the last point we wanted to make here is that really within the last 12 to 18 months, the markets have been all over the place. And if you compare the sales that have taken place really all throughout the year last year in this particular market, they were very strong at 186,000 to 209,000 per door. Cap rates were in the low to mid 4s. And while there haven't been that many trades recently, what this kind of speaks to is the fact that this is an off-market deal through a relationship with one of our co-GP sponsors. And I think we're getting it at a really strong basis at just under 170,000 a door compared to the average here of 190,000 per unit. Just more support for this really good basis. And then finally, we just wanted to show the returns. What does a $100,000 investment look like over the 7-year hold period? The cash on cash is projected to be roughly 6.5%. The internal rate of return, 16.31%. And then the equity multiple of 2.72x, which results in an average annual return of 25%. And then in addition to that, we'll do a cost segregation study. And we're expecting that the 80% bonus depreciation will provide roughly 68 to 78% of that investment in the form of year one depreciation. So that should be very strong. And I believe with that, I'll hand it over to Ray for next steps.
Thanks, Marshall. Now that you have received some detailed information on the investment and business plan, I want to discuss the next step for those of you that are planning to invest in this project. Here is the basic project timeline. Funding is going to be due at the end of August, and we are already taking subscriptions. Your sponsorship representative has already provided the link to the investment portal, and all of the paperwork that you need is inside the portal. We make it real easy, one-stop shop. Once we close and quickly begin to execute the business plan, which will take about 2 years or so, we'll then sit pretty and time the market to provide the best exit for our investors. As we sit right now, we're at about 85% subscribed. So if you are interested, I highly suggest you move forward, jump on the portal and register if needed. Take a look at the documents, sign the e-sign subscription agreement, and fund the investment as per the wiring instructions on the portal. We accept cash, IRA funds, and solo 401k or qualified retirement plan funds. I cannot stress this point enough. This is a first fund, first serve opportunity. So complete your paperwork as soon as possible. Even though the portal walks you through each of the steps, your first investment of this type may seem daunting. If so, don't hesitate to reach out if you have any questions whatsoever. My partners and I thank you for your interest and time. As always, invest where it makes sense.